Hello, swing traders. Listen up. If you want to spot market moves before they happen, you need the right leading indicators in your arsenal. And in this video, I'm going to break down the best leading indicators for swing trading. All right. And I'm going to be showing you exactly how to use them and give you key strategies to maximize their effectiveness. So stick around till the end and you'll learn how to time your trades better and avoid false signals. Okay, let us get started. First things first, what are leading indicators? And why are they so important for swing trading? Well, leading indicators are tools that help predict future price movements instead of just reacting to them. Unlike lagging indicators like moving averages that confirm trends after the fact, leading indicators give early signals of potential reversals, breakouts, and trend continuations. For swing traders, these indicators are essential because they allow you to enter and exit trades at the right time instead of waiting for the market to fully make its move. So let's just jump into some of the best leading indicators that you can start using right now. All right, let us dive into the top leading indicators that can help you time your trades more effectively. The first indicator we're going to be looking at is the relative strength index. All right, now one of the most powerful leading indicators is the RSI, or relative strength index. It measures momentum and tells us if an asset is overbought or oversold. An RSI above 70 means the market is overbought, signaling a potential reversal downward. An RSI below 30 means the market is oversold, indicating a possible bounce back up. Now, swing traders use RSI divergences to predict trend reversals. If the price is making new highs, for example, but the RSI is making lower highs, it's a strong bearish signal. Okay, let's see if we can find such an example. Okay, we can see one here. You can see that the price was making higher highs and the RSI made lower highs. That is what we call a bearish divergent, and you can see shortly afterwards we had a bearish reversal. Okay, the opposite applies for bullish reversals. Now, the second indicator we are going to be looking at is the stochastic oscillator. It is another momentum based indicator that a lot of traders use. Okay, similar to the RSI, the stochastic oscillator compares closing prices to their price range over a set period. Now, when the stochastic crosses above 80, the market is considered overbought. But when it drops below 20, it is oversold. All right. Now, the key here is looking for crossovers. When the fast moving line crosses above the slow moving line, remember that the fast moving line is the green line, right? The green line, when it crosses above the red line, it's a buy signal. And when the green line crosses below the red line, it's a sell signal. Okay, so when you have the bullish crossover, of course, within the oversold territory, it's indicating a bullish opportunity, and when you have the bearish crossover within the overbought territory, it indicates a selling opportunity, right? So the key here is to just look for crossovers. Okay, this is an excellent tool for spotting short-term reversals, and it works even better when combined with the RSI. Now, the third indicator we have is the Fibonacci retracement. Okay, the Fibonacci retracement is one of my favorite tools for swing trading. Okay, the Fibonacci retracement tool helps identify potential support and resistance zones. All right. I'm just going to change this to black. Okay. All right. Now, markets really move in a straight line, right? They pull back before continuing their trend. Fibonacci levels, especially the 38.2%, the 50%, and the 61.8% retracement levels, are key areas where prices often reverse or bounce. So swing traders use Fibonacci retracements to find entry points during pullbacks. When price retraces to a Fibonacci level and bounces, it's often a great entry signal. Now, the final indicator we're going to be talking about is the Bollinger Bands. Bollinger Bands help measure market volatility and indicate potential breakouts. When the bands contract, volatility is low. This often signals a potential breakout is coming. Then when the bands expand, volatility is high. This is when price is making big moves. Now, swing traders use Bollinger Band squeezes to anticipate breakouts before they happen. If price is near the lower band, it could be a buying opportunity. If it is near the upper band, it could be time to look for a short setup. Okay, now before you go and start trading with these indicators, here are a few pro tips to help you use them the right way. First of all, do not rely on a single indicator. Always combine multiple indicators to confirm signals. For example, pairing the RSI with the Fibonacci retracement tool can improve your accuracy. Okay, look for confluence. If multiple indicators give you the same signal, it's a stronger confirmation. Okay, and practice risk management. Even the best indicators are not 100% accurate, so always use a stop loss to protect yourself from unexpected moves. Okay, and finally, use indicators in the right market conditions. Some work better in trends while others are best for range bound markets. So understanding this will improve your success rate. And that is it. Those are some of the best leading indicators for swing trading. Now I want to hear from you. Which of these indicators do you use the most? Drop a comment below and let us discuss. If you found this video helpful, hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss any future swing trading strategies. Thank you for watching, and I'll see you in the next one.